Hi, a very good evening to all our clients and audience for taking time out for an engaging conversation on macros and markets today. When we interacted last time post budget in February, we were still grappling with the flip flop around trade war. If geopolitics was a dominant theme then, so it is now, with the West Asia conflict being still at the center stage. When the conflict started on 28th Feb, none of us could have imagined that it would last this long. But as we speak, it is still
It's
continuing,
continuing
and
and
with crude still hovering at around
moving.
90s. Markets have seen sharp fluctuations. We saw a very steep drawdown in March, and then we have seen a strong recovery April onwards, especially in the broader markets.
It's
Nifty, however, still remains where it was 2 years back, even as corporate India witnessed one of the strongest quarterly earnings in recent times. We indeed live in very, very interesting times. To
times.
discuss this and more, we have two industry veterans with us today. Mr. Pankaj Tibrewal. Pankaj brings over 2 decades of experience in investing. Currently, he is the founder of IKIGAI Asset Management. Before that, he was in Kotak Asset Management, uh, where he managed Kotak mid cap and small cap funds. A lot of us would have had SIPs in that fund in past. I also have it. So thanks, Pankaj, for your time today.
Thanks,
Uh,
Mayank.
we have Rajesh on the panel from AlfAccurate Advisors. He has been managing AlfAccurate Advisors. He started AlfAccurate around 1.5 decades back. He has over 3 decades of experience in investing and is known for his style of investing and identifying themes early. Thanks, Rajesh, for your time as well.
Thank you.
I am Mayank Sharma. I take care of asset allocation and client associates, and I am your host for the webinar today. So, without further ado, let's start. So, Pankaj, starting with you, uh, India entered the West
India
Asia.
entered the West Asia
There seems to be some echo.
seems to
Sorry.
be some echo. Sorry.
India entered the West Asia
India entered the
conflict from
West
a
Asia
position of
conflict from a
strength.
position of strength.
Are you also facing
We also
echo?
facing echo.
India entered the West Asia conflict from a position of strength with stable macros, strong growth, contained inflation, manageable CAD, BOP. With all the West Asia conflict still in progress, what risk do you see to the growth inflation dynamics going forward?
So, good evening, everyone. I think the world before 28th of Feb and after 28th of Feb are two different worlds we should be aware of. And with all this geopolitics, spanning out, I think our view is that inflation is going to stay higher for long. Over the last 20-25 years, if you look at, and especially the last decade, inflation has been suboptimally low. And that gave birth to a lot of risk asset classes in terms of valuations which went crazy. Now look at post 28th of Feb. One of the most important indicators in the market is the bond market. And if you look at globally, the bond market is saying that we want higher yields because we believe inflation is going to be much higher going forward. And hence, our thought is that across the board, which whatever reasons, commodities, a lot of because of geopolitics, uh, the inflation is going to remain higher. That means countries, companies all have to work a little more higher to beat inflation over a period of time in terms of growth. And even from a bond yield perspective, one has to be a little careful because globally, bond yields are refusing to come down. Even in the US, 30-year bond yield has crossed 5.2%. 10-year is at more than 4.7%. So bond yields are clearly indicating that higher inflation is going to be the order of the day as you move ahead, and that one has to be built in from a global growth dynamics perspective. Only the way India has managed its thing, We have seen some increase from 28th of Feb on a 10-year bond yield, but not as much as most of the advanced economies have seen, whether it be UK, Japan, Europe, US, all have seen between 50 to 100 basis points movement on the bond yield side. And that means inflation is a worry going forward also.
Thanks, Pankaj. Rajesh, would you want to express your views on broad macros?
Well, I think, clearly the higher crude oil price, that's the most important thing for India, and that remains a risk. But I would distinguish between a shock and a structural deterioration, correct? The transmission mechanism is fairly straightforward. High crude, higher cost, high inflation, and we are still oil dependent. But there are also cushions because we should not forget that this time when the US-Iran war happened, India's situation was significantly better compared to what happened pre-COVID, or when we compared to Russia-Ukraine war. Like for example, if you look at the 2-3 important parameters like credit growth, that time was only 6%. This time when US happened, we were 13% credit growth. Our household consumption was only 6%. This time it is 9%. The liquidity in the system was 2 trillion. This time it is 6 trillion. The inflation before Russia-Ukraine war was 5.5, whereas this time it was 3.2 before the war. So what I'm trying to say is that India structurally today is much better positioned compared to what it was during the previous crisis, be it a COVID crisis or be it a Russia-Ukraine war crisis. The domestic demand is reasonably resilient, and the government has some fiscal flexibility to manage the impact through taxes and pricings. And lastly, of course, RBI is more credibility and policy stance compared to what it was in the previous cycle. So if anything beyond $100, that becomes a little bit more worrisome if it sustains there, but I don't think it's going to sustain. Otherwise, let me tell you, Mayank, that, too much reading into the global data print generally never helps. When you are taking view on the Indian equities, look at India inflation, look at India bond yield, look at India credit growth. US debt has gone up. So clearly, for 30 years, guys, US investors will ask more premium. But that doesn't mean bad outlook for Indian equities. In fact, it can be different world altogether because our inflation is now equal to US inflation. So I think India has managed it well till now. Anything higher than $100 on a sustainable basis, that's the key risk. Otherwise, we are fairly on track. And if you ask my personal view, I'm very much optimistic from here.
Great, Rajesh. Before we move to Indian markets, Pankaj, you have been quite vocal about the AI-driven rally in US. So, and obviously some of the other emerging markets. We had seen sharp corrections in the month of July as well across emerging markets, where Korea saw a 22% correction, SOX was down, US Nasdaq was down. So with the increasing capex and obviously some of it being borrowed even from initially coming from internal accruals, but now obviously some of it is coming also from the private credit markets. Do you see this as sustainable, or do you think this is a bubble in the making? Pankaj, you're on mute.
So there are two parts to it. Is AI real? Answer is yes. So every day we are seeing things on AI, and the way world is moving in terms of productivity. I think AI is clearly the order of the day. It happened exactly 26 years back in 2000. Internet has changed the lives of the way we do business, and businesses have grown exponentially post that. But during that time, we gave insane valuations to a lot of companies, and many of them have disappeared, even though internet has stayed. Our view is exactly similar, if not the same, that AI is real. It is transforming the lives, businesses across the world and globe. But the price which we are paying or the way it is operating, I think is something which is bringing a challenge. And we saw that a bit of that unwinding itself in the month of July. And there was too much of greed chasing it. Um, Look at, I was looking at Asian markets. Look at 96 index of Asia ex Japan. And none of those top 15 names are present in today's top 15 names. Those top 15 names were real estate, Hutchison, which was a telecom player at that time, and many other names. Banks, few of the banks were there, oil and gas companies were there. And today on the top 15, the first 5-10 names are all semiconductors and AI chips and all. So obviously there's been a huge transformation which has taken place. The question is, will 10 years down the line, same companies remain to be on the top 10, top 15 of Asian list, or it will be a very different one? My guess is that it will be, many companies will be very different. And don't forget, these are cyclical industries. All the memory, the other things, and totally in the world, only 5 companies have survived and returned cash back to the shareholders over the last 25, 30 years. So it's not that it's a single way. Today, yes, obviously the momentum is very high. But few data points, like for example, you look at this quarter numbers. In this quarter numbers, what was interesting to know that all the hyperscalers have significantly come down on cash flow generation as a free cash, right? And a couple of them have actually been negative on free cash. And compare that to the free cash generation of all the chip makers. So the money has transferred from hyperscalers to here, and there is a off-balance sheet commitment of almost $3 trillion by these companies. It doesn't look on the balance sheet right now, but if you look at the off-balance sheet and the other lease commitments, it's about $3 trillion. So it's a large sum, which means at some point of time, most of the shareholders of these hyperscalers, Google, Meta, Amazon, everybody, will ask that you are investing 700, 800 billions cumulatively every year into this. Where are the returns? And today, the return model is still not concrete, that how much a data center in terms of, or a LLM in terms of justification of those models in terms of returns. Even if you invest 700 billion, at least you would expect 15% IRR on those names at $100 billion. But there's no sight of that. So at some point, I believe there will be some backlash by the shareholders of the existing hyperscalers who are spending a lot, and tough questions have started being asked already by both the board and the hyperscalers. That's the first point. The second point important to note is that we all are drawing a straight line, that this much of data centers will come, this much of things will happen. But don't forget that behind that there is an infrastructure need in terms of two important things, which is power and water, which goes into a data center. And already in the important places where such capacities are coming in Texas and others, you just Google it out. There's a huge social protest which has started to happen because power generation doesn't overnight increase, and hence there will be a bottleneck on power as well as water supply, because you are cutting out the power supply of somebody else and providing. And already load sheddings have started in many parts of US, and power cuts have started in many parts. So that's actually creating a social unrest in many of these places, and people are very clear, whichever politician supports this, we will not vote for them, whether it be a Republican or a Democrat. And I think that same problem will happen in most parts. So our point is that today people are extrapolating everything into the next 3 4 years and saying that this much is the kind of opportunity, and there's very little margin of safety. And I will be a little careful on that trade, because it's too good to be true. AI is real, but there will be hiccups along the way. And I think markets are so over leveraged on this trade that you saw in the month of July alone a bit of negative momentum, and how does things starts to unwind itself. So that's what we have wrote in our quarterly newsletter on different points on how this AI trade, one needs to be careful, especially on the value which we are subscribing to many companies and extrapolating that into the future.
Right, Pankaj. Now coming to Indian markets, so in September 24, 2 years back, on the back of high valuations and slowing earnings trajectory, we started seeing a correction in the market. 2 years down, we are for broader markets, while we have seen some progress, but on the Nifty, we're still where we were. And we had seen a massive underperformance against global markets. So, Rajesh, according to you, what are the key triggers for the markets going ahead?
So I think, actually, if you think through it, the last 2 years have been I would say, healthy period of digestion for the Indian market. So earlier 2 years back, as you rightly said, the valuations were a little bit expensive. Market was running a little bit ahead of earnings. And therefore, what we needed was either a meaningful correction in the stock prices or catch up in earnings. We are largely, basically, I would say, into the second part. That's the catch up of earnings. That's what is now is playing through. So the interesting part is that the earnings are started to reaccelerate, and that's good news. Look at our first quarter numbers. Everybody was skeptical because everybody was expecting that US Iran oil will significantly impact the Indian corporate earnings. And interestingly, in first quarter, not only the earnings growth has been strong at 15% plus, but if you look at the breadth of earnings across the various sectors, across the market cap, you just exclude the OMC companies because oil marketing companies, they have either huge inventory gains or huge inventory losses. If you remove it, most of the sectors, most of the companies, be it large cap, be it mid cap, be it small cap, have reported quite decent numbers. In fact, few of these companies are 18-20% plus growth, despite the volatility in crude price and despite the supply chain bottlenecks. Going forward, I think the important triggers are two. One is improvement in earnings growth, which has to continue. And if it becomes, 14-15% kind of number, then valuation will look much more comfortable. And second, I think very important is revival in private capex and the investment. Because as that happens, the capacity utilization keeps moving up, the demand underlying is reasonably strong. And hence, normally, I always say that whenever you want to take a judgment on economy, look at three indicators. So first is the credit growth. Our credit growth now is close to 17-18% compared to last year 9%. Second, look at consumer. Most consumer companies, after a very long time of 4 years, have started talking about good numbers and good commentary. Look at any company. Look at, for example, watch companies. Look at the largest mall of the country. Look at 4 large FMCG companies. Look at 4 large discretionary companies. All have reported good numbers. And number 3 is your capex. Government capex is strong and private sector capex has started going up. Whenever there is a trinity of credit, consumption, and capex, corporate earnings growth improves. So last year earnings growth was 9% for Nifty. This year is like to be 12-15%. And as earnings growth improves, values are still reasonable, below 10 years average PE. And therefore, as I said, that picture looks quite reasonably good. And I think from here, these triggers will finally play out.
Pankaj, your thoughts on this and also on the earnings season, which we have seen. I think we have seen a very, very strong earnings season. How do you see it going ahead?
So I completely agree with what Rajesh said. And I always have been saying that a certain amount of inflation is always good for corporate India. And I think this quarter was a quarter of resilience, if you ask me, demonstrating corporate India. Why do I use the word resilience? Normally, you see that in the top 500 companies, roughly between 45 to 55% of the companies report more than 15% earnings growth. This time, the number was almost touching 60%. That means across the breadth of the companies in the top 500, there was decent momentum across top line and bottom line. And when top line starts to move in 18-20%, even there is a gross margin dilution, the fixed cost doesn't improve at the same rate. And hence your EBITDA margins is contained to a certain extent, and that was the surprise which we saw. And after 12 quarters, we have seen more than 20% top line growth, which has happened. And this is after many quarters that the breadth across large, mid, and small has been very strong. And especially small caps, which delivered more than 30% earnings growth. So I think underlying momentum at the ground is quite good. And companies after companies, which we are meeting sectors after sectors, even July, which normally is a lean season because of monsoon, you will be surprised that the commentary coming out has been very solid. So we met the largest private sector steel company, and their commentary was, we have never seen July be raising pricing and demand being so strong. We have raised actually long product pricing. That means construction activity is happening. We will soon be doing the anniversarization of the GST cut. If you remember last year, everybody said auto to 2-3 महीने का ही है, खत्म हो जाएगा. Now this is 10 months in a row that autos have demonstrated very strong growth across two wheelers, four wheelers, uh, farm vehicles as well as CVs, which is not out of float. Nobody buys autos just for sake. Then, as Rajesh said, on consumer side, there's finally some life coming on consumer side. Retail banking growth, corporate credit growth, across different parameters. If you look at, things have been good. And if you just step back, why is this happening despite of all the challenges? India survives on liquidity. Let's be very, very clear on that. Whether it be corporate India or retail demand, you need liquidity into the system. And since January 25 till now, RBI has infused 18.5 lakh crores of liquidity, either through open market operations or dollar swap or whatever. And again, from 6th of June, you look at the currency. So crude has gone back to $90-$100, but this time from 6th of June, after the FCNR announcement, currency hasn't moved, which is also a very, very big, important sentimental positive from a overall thought process. Because when keep currency keep on going down, it creates a negativity again in the minds of people. From 6th of June till now, currency is actually in that range of 95, 96 or 94, 96. And yesterday we saw 72 billion has already come into the FCNR plus OFCNR combined. And this number will cross 80 billion as we close the scheme. So the point which I'm trying to say is that when you stitch upon all these macro and micro things together, and with the feedback from the ground, and also the fact that second quarter of last year is a favorable base for us, because it was the most extended monsoon we have seen in last many years. That means this quarter also will look quite strong. And then the third quarter, you will see the festive season this time getting postponed to the third quarter. So broadly speaking, I think economy across the board is showing decent traction as far corporate earnings growth is concerned. Now your question will be, अगर earnings आ रही है तो market क्यों नहीं move हो रहा है, बुरे लोग क्यों नहीं आ रहे हैं? The fact is that we are never in isolation. We are relative. Life is relative, right? And अगर अपने markets को देखते हैं, हम 22% 23% earning growth देख के खुश हैं, but US में this quarter was 26% earnings growth on this base. So markets are saying that if US can deliver 26%, I need something more in India to invest. तो वो भी आएगा, but I'm thinking that currency depreciation रुक गया है. Micro data points have started to be very strong. Macro is in a reasonable shape. We all thought balance of payment will be in deficit. Now May, June, because now government has started giving you monthly data on BOP. Both were positive. Remittances, which we thought would come down, is actually gone up. So May and June saw $15 billion of remittance per month compared to 10 billion in the last year. So people were feeling unsafe and they transferred the money back home. So when you combine everything together, I think macro, we could have been in a much worse position, but we are in a stronger position. And even on the GST side, government has budgeted a decline, assuming the cut last year. But GST till now is surprising us, and last month was 15% growth on the GST side. So when I combine everything together and with the consolidation which has happened into the market over the last 2 years, I think overall market seems to be decently poised, and already in the stock specific movements you have started to see, though Nifty is not reflecting that, but from March lows you have already seen broader market doing far better than the Nifty itself, and there's been a huge alpha which has got created between mid small on one side and large caps on the other side. So I think it will be a bottom up market. Companies which will deliver strong growth will be liked up by the markets. And that's what we are seeing in today's market environment.
Thanks, Pankaj. Rajesh, wanted to understand at this point of time, which are the themes which you like from a medium to long term perspective?
Well, I think the opportunities are across, and broadly, if you look at it, the one is of course the financialization and financial services. India's credit penetration and financial savings opportunity remains structurally attractive. If you look at the credit growth has improved to 18%, that's the most important thing. Disbursement growth is therefore quite solid compared to what it used to be last 2 years. Last year, worry was net interest margins. This year, hopefully, from second quarter onwards, this worry will be behind us. And the asset quality across the banking segments, be it microfinance, be it commercial vehicle, be it a consumer finance, be it a corporate banking, be it a housing finance, because banking, you need to do further segmentation. And most of the segments, credit cost is quite reasonable. In fact, we have seen some improvement in trends, further improvement in trends. So I think banking and finance in the sector will continue to do well. Second is consumer. In consumer, I think the discretionary segment is one segment which we are more bullish on compared to the FMCG as a segment. Within discretionary, you have a number of pockets. Retail, for example, is one opportunity where rising aspirations and also improvement in affordability, both together can lead to acceleration into the retail spending growth, and the few good companies which can capitalize on this two pillars, affordability and aspiration. If you can meet these two 2A, then surely you can win the customer heart and mind share and wallet share. Third, of course, is the capex related themes. But here one needs to be a little bit more specific rather than play the the broader areas of growth. Because on one side, I think the infrastructure like road, ports, railways, irrigation, construction, you will see, I would say, single digit kind of a growth. So nothing much to create long-term wealth. But on the other hand, you have a new modern growth drivers like data centers, robotics, automation, transmission capex, nuclear energy related segments, the aerospace, defense, EMS, because government has realized that PLI is working and there is no other way but to continue to accelerate PLI across the various segments. And that's huge positive for industrialization of the country. And I think that's a very important requirement because it also leads to higher employment opportunities. And therefore, even from the World Bank perspective, it makes sense. So I think the capex, but within capex, you need to be very, very selective. There are a few pockets which are seeing exponentially high growth. The fourth segment is healthcare. And again, we do segmentation. So within healthcare, I think CDMO is a huge opportunity. China plus one is happening across manufacturing, and CDMO is also one such opportunity where China plus one is going to happen after 2, 3, 4 years. The process has already started. And hospitals within healthcare is one more space which is interesting. Last but not least, when it comes to the platforms, I think platforms is becoming a very interesting opportunity. Many of these platform companies have evolved over the last 4, 5 years. Many of them become now profitable. Their scale is huge. Their market share is also quite large. And now they have turned profitable with scale and with efficiency. As the scale further accelerates, because private equity investors have also become what I would say more demanding, and they are now also asking ROE, which is a good news. And it means the existing platform companies, which are already market leaders, they will gain further because other companies probably will drop out, and there'll be some burnout probably in the unlisted space within these platform businesses. So the listed companies will benefit further. Their market share will further go up. Their margin efficiency will further improve, and therefore even the valuation and growth both will also do much better. So these are basically 5, 6 themes. Of course, there are niche segments like auto ancillaries on which we are extremely bullish over the next 4, 5 years. Many of these ancillary companies, they are moving away from traditional auto and they are now moving into aerospace as a business. Please remember that Europe is facing a huge, I would say, challenge. On one hand, their fuel cost is going up. And on the other hand, they don't have, I would say, enough workers. Second generation is not there. And therefore, many of these companies, be it aerospace, be it auto ancillaries, be it castings, they are moving their businesses from Europe to India. many global customers. They are pushing European companies to expand, but European companies, many of them can't expand. They are very boutique companies. It is not like $2-3 billion companies. These are typically 200 to $500 million kind of revenue companies. And if they don't expand, it's a problem for the end consumer and customer like Boeing, Airbus, Volkswagens of the world. And therefore, now they are saying to Indian companies, why not you take this revenue share? So I think the opportunity is pretty large. And on top of it, the government has done multiple FTAs. And as those FTAs also come into effect over the next 2, 3, 4 years, the opportunity is quite sizable. In each of these, of course, verticals, we need to be much more stock specific. And there are enough opportunities where growth can be 18-20% plus over the next 2, 3 to 4 years.
Pankaj, what about you? Which are the themes which you like at this point of time?
I think Rajesh has touched upon most of the themes, but just one thought process which I would like to keep you guys with was that there is a significant depreciation of rupee, which has happened not only against dollar but also Chinese yuan. And many companies whom we are speaking to, after a long, long time, they are saying that we are seeing a very strong demand on export side, uh, and it's across sectors. So you speak to textile guys. I have not heard them that textile guys saying that we are capacity booked across the board, and tailwinds there because of FTA and stuff like that from Europe, UK, and others. Second, you speak to most of the companies on the chemical side. So there's double edge out there because you are up almost 15-16% depreciation against yuan. So one is like the export demand, and the second is the aggressive dumping by Chinese, which was happening for the last 3-4 years because of import substitution starting to play out now. So when you combine these two things, then there's a very sharp correlation, Mayank, between rupee depreciation versus yuan to the top line growth of chemical companies. Go back into the history, whenever that has happened, you have seen a very sharp acceleration of top line growth of chemical companies. And first quarter, you look at the numbers, crazy numbers across the board on chemicals. But market is saying a large part is inventory gains, not sustainable. Even if these spreads continue at even 70-80% of what we saw in the first quarter, I think street is still not factoring in those numbers. And our call is that chemicals is a place where you can play it with specialty, maybe companies which are on import substitution and others. I think that could be a very significant play. And third is across the pharma space on healthcare and the domestic and the CDMO side. Though valuations are prohibitive, it's not the cheapest of the sectors right now, but growth could keep on surprising you on the upside. So apart from the sectors Rajesh mentioned, just few thoughts that rupee depreciation, and if rupee stays here, many sectors on export side could surprise us. Just to give you an example, today morning we met a guy who's coming for IPO. It makes glass facades. So any commercial building you see, the glass facades, they are the second largest company in the country. And 4-5 years back, they started exporting to US especially. And the kind of demand they are seeing, because everything was dependent on China for supply chain. And the largest guys there are saying that we need an alternate supplier along with them. And this company is able to match on costing as well as on quality alongside Chinese. So finding huge favors from countries in Europe, Israel, because Israel after the war will have massive construction of buildings taking place. US is seeing a kind of a second supply chain partner along with it. So I'm saying that in today's environment and along with the rupee depreciation, they have become far more competitive, the Indian guys. So the point which I'm giving you just this an example is the same scenario is spanning across many sectors. And I think that's a real big opportunity from a growth perspective of many exporters. So identify those niche areas where Indian corporates are far more competitive, and you will see an opportunity. We met the largest PVC guy in India, and they are saying that there's reverse inquiry taking place from markets we haven't gone on the PVC export side. When did that happen? So I think there are many such opportunities emerging, which in my view could be approached from a bottom-up perspective and try and look out for these export opportunities. It could be massive, game changer because the global size is huge, and we are just a tiny spot. In that also we can get some growth. I think for a company specific, it will be massive growth. So we are looking out for those opportunities where we believe export they have a right to win. A recently listed IPO which makes machinery, you saw that how growth surprised on the results after they declared on order books as well as the growth, and they pretty confident that this growth numbers can sustain for future also. So such opportunities I think will come, and we have to be open. So export as a theme, I think is a quite a very significant one, and we remain positive on that, and there will be subsectors in that theme.
What's your view on defense, Pankaj? Given I think India is looking to export its defense equipments, especially after what we saw in Operation Sindoor, but obviously valuation remains expensive. How are you looking at that sector from export perspective?
So huge runway for growth, right? And companies after companies we are meeting, this entire ecosystem has started to buzz, right? I recently met a few unlisted guys, Mayank, very interesting. So I'm sure everybody must have watched Safed Sagar recently, which got released on Netflix, right? The reason we had a problem in Kargil because of GPS, right? We didn't had our country didn't had our own GPS, and we relied GPS on US, and they maneuvered it the way they wanted from their radar. These bunch of set of IITians are creating their own GPS system, the first time in India, a national asset. Then you look at a company we met again, a young bunch of folks, a drone which can be operated without a GPS system, and GPS, without GPS you can operate that drone. Normally you need signals to operate with the GPS on a drone side. You don't need that. So such innovations have started to happen on the ecosystem in India, and I believe that if you take a 5-10 year runway, many new companies will get created. And I'll give this example that one of the companies in my career which surprised me on 500x is a company called Solar Industries, right? And it got IPO'd in 2006 at 500 crores market cap. When we bought it was a 1,000 1,500 crore market cap. Today it's a 2 lakh crore market cap. And 5-6 years back when they entered into defense, everybody thought they are making a mistake. This year they will be at a 4,500 crore run rate on defense revenues, and looking forward more, and the kind of Pinaka missiles and everything. And many such companies are being created in the ecosystem. So I think runway for growth is huge. Only valuations are prohibitive. So you really need to take a very long-term view in this sector and companies, and there will be disappointments along the way because finally it's a B2B and B2G. So large part of India business is B2G. It can be lumpy because you think about a project as 1 year, but it can be 3 years. Does equity market has patience to give you 2 more years in terms of execution is always the thought. But many companies will also see exports, and companies which have a right combination of both domestic and export, I think, will be the real winners, because in domestic projects can get elongated, payment can get elongated, but on the export side you have time specific delivery requirements. So if you get a right combination like the Solar has done, they have both domestic as well as export in terms of different emanations and export opportunity. I think you can be a real winner over the medium to long term. So I believe the sector has huge runway for growth, both on export and import, both on export and domestic. And 6 years back, who would have thought we would export almost 40,000 crore in terms of defense? But that's the reality. And today, we read in the article that $6 billion of opportunity on BrahMos itself on the order book. and all the countries are lining up to get delivery of BrahMos from government. So I think there are different opportunities, and ecosystem has started to buzz around innovation, and I think it's a very very heartening change. So remain positive and constructive. Only thing we have to be very careful about valuation side.
Thanks, Pankaj. Rajesh, now coming to market caps, mid and small cap segment has seen a much faster earnings growth compared to large caps in the past quarters. You manage a flexi cap as well as a mid and small cap strategy. In terms of relative attractiveness between the three segments, which are the ones which you are liking at this point of time?
One important point which I would like to draw attention to your viewers is that India is the only country in the world where top 100 by market cap is called large cap. Sort of 5,000 listed companies, 100 are called large. So 2% of India is large cap. 98% of India is tagged as a mid and small cap. It means first 100 is large, next 150 is mid. So from 250 to 5,000, every company is painted with same brush, which is a small. And that's where the distinction needs to be made. Because 250 first company is a different size compared to 5,000 company, it is a completely different size. So what I look at is I look at the profit size rather than market cap. And when you do that, there are only 1,000 companies in India in the listed space, which makes 100 crores plus net profit after tax, broadly. These 1,000 companies may say 100 companies are tagged as a large and 900 companies are tagged as a mid and small. This next 900 is actually our universe, the way in which we look at mid and small. They are actually large, but they are tagged as a mid and small. So by that definition of top 100, India's largest mall, India's largest luggage company, India's largest plywood company, India's largest tiles company, India's largest capital goods company, which is into the transmission, India's largest diagnostic chain, both of them, and many such companies, therefore they are tagged as a mid and small. But this next 900 is where the growth opportunity is going to be huge. See, think of it. It is not that large caps are bad. It is not that the large caps don't give returns. The problem is our GDP growth of 11% plus is a minimum requirement when you look into equity market. Anything below 10%, probably investors are not going to be happy, clearly, correct? And when you look at large caps, generally speaking, when I say large caps, I'm not talking about a mega caps, top 30, 40 companies kind of thing. The growth opportunity of that universe is below GDP growth. And that's where the problem is. Not for everyone, but most of them. Whereas you look at in mid and small, you have a 900 companies to select from. So your pool of opportunity is 900. From that 900, you need to build a portfolio of companies, 30, 40, 50, 60 stocks, whatever it is, which is just 5% of the universe. And there are enough opportunities within this 900 which can potentially deliver 18 to 20% growth, significantly higher than the underlying GDP growth of the country. And that's why by default, this space is going to outperform the mega caps. Also, earlier there was a myth that, there are many guys that say mid and small caps, they are vulnerable. What if the market goes down? The drawdown is much sharper. That's true when you actually do the micro cap. Of course, everybody's thing calls mid and small in India, but otherwise from 1,500 companies, that becomes absolutely right. But when you look at to give an example, Nifty median debt equity ratio of mid cap index or debt equity ratio of even small cap index, it is close to zero. And therefore, when you look at the first quarter results, somebody would have thought 5 years back that if the crude oil goes up, small cap companies, NSE 250 or NSE mid cap index, the earnings should have been significantly lower. But it is not. Why? Because your debt equity ratio is close to become zero. Their ability to survive has gone up tremendously. They are no more vulnerable. In fact, many of these companies are debt free, and therefore their ability to invest for the future growth is significantly higher. And hence, by default, therefore, your ability to invest and therefore ability to be resilient, and that's very important, so that your drawdown is lesser, and your ability to grow is significantly higher in mid and small compared to, of course, mega cap. Last but not least, when you look at the migration, upward or downward, both ways, we should remember that in the last 9 years, 1 out of 5 mid cap and 1 out of 4 small cap, they migrated to the upward movement. Means either mid has become large or small has become mid and large. Whereas 22% of large caps, they moved down from large to either mid or they became small. So you have a two-way effect. One is earnings growth is much faster, and second, there is a possibility of upward migration of your market cap bucket. And when you do both, there is earnings growth plus some valuation relating, and therefore potentially this bucket definitely will outperform the mega caps. Of course, the volatility is going to be high. You need to have a little bit longer time horizon. You need to make sure that volatility should not disturb you. So to that extent, little bit risk is higher. But it is not like risk of 1990 and 2000 that you are investing into debt equity 3:1. No, their ROEs of mid cap index is almost equal to large cap. ROE of small cap index is equal to large cap. But growth is much more stronger. And therefore, that basket, with a medium to long term view, 4 or 5 years kind of time horizon, definitely will be higher than the large caps.
Thanks, Rajesh. Uh, Pankaj, we have seen a spate of listings in the new age companies in the recent times. Some of them have struggled as well. Some of them are below their IPO price. How do you view these companies, and do you find opportunities in this space?
See, obviously, if you look at what India transformed from 1 trillion to 5 trillion and companies which created value, obviously the journey from 4.5, 5 trillion to 10 billion will be very different. There is a thumb rule that about 10% of the market cap in any emerging economy comes from new age businesses in terms of market cap. Today, there are about 65, 70 listed companies now in India, and the total market cap, which was virtually absent on the uh, almost, very, very little market cap, is now about $165 billion market cap. So roughly about 15, 16,000, 15, 16 lakh crores of market cap has been created over the last few years. Many of them will probably have changed the way India consumes, right? Some of them have become category leaders. Some of them have redefined categories, created new categories, and some of them are disrupting the old legacy businesses. I think there's a space for everybody to sustain. And what the first phase did was your trinity of Aadhaar, mobile, and the social identification and mobile number. That trinity created many new age businesses. With AI coming in, many businesses on the new age startup side will see compression in terms of go to market. And hence, our view is that the space you have to have an open mind and have allocation attached to it, because many of these businesses will grow much, much faster than the incumbent, and they will take away market share. So I think quite pro towards that, but you have to evaluate them very closely. I don't think every businesses will survive. There will be many deaths along the way, but the ones which will stay in the game will become very large, in our view, and that's one big change we are seeing. Second, you also asked Rajesh about the market capitalization, valuations, and stuff like that. Uh, so always keep in mind that optically the headline valuation for mid and small cap will look to be higher than large cap. The reason is that 3 4 years back, the weightage of all the new age businesses in mid cap index, for example, was 1 or 2%. Today it's more than 10%. You have the Nikas of the world, you have the Policy Bazaars, you have the Grows, you have the Mishos of the world. Everybody is there, and these are either optically loss making or very high on P. So index valuation suddenly looks to be higher because 10-12% weight of new age companies also dilute the index valuations overall. And similarly in small cap, you have urban company and many other new age travel and other related businesses which are part of it. So I think only looking at headline valuations will not serve the purpose. Uh, had only we looked at P, I think people missed out on a lot of opportunities. Similar is the case here. Look at what peg you are paying for it, which means for the earnings growth which you are paying for this index, how much you are paying for the valuation. And when you look at that, sync is not very bad at 1.5 time peg, normally for the mid and small cap combined as an index as a whole. So I think you have to look valuation in context of growth, and then also look at a lot of new age businesses which were not there are now present. So optically, every time you will see that this space is expensive than large cap, then why to invest? Asset allocators will always take a call, and then probably you will lose out on the overall alpha generation. So look at since March till now, there's just 18-20% differential between index return itself, right? Between large caps and mid cap and small caps. And if you remember in March, Feb, everybody was saying just go to large cap, be safe, be safe. That's the first area which will come up. And hindsight is always good, you know. And now look at what the numbers are. So I think focus on grounds up businesses, bottom up businesses, and many new age businesses, in my view, will create a lot of value. I think we are going through a massive transformation globally. Look at this way, the world is becoming more interconnected place, right? 2008-9, 2 billion people on the planet were connected with internet. Today that number is 5.5 billion people are connected with internet, and in 4 years 7 billion people will be connected with internet. That's 90% of the planet now being connected, hooked on to the entire internet gamut. And hence the way of doing businesses will ultimately be very different from the traditional way of doing businesses, because everybody is connected in a way in any part of the world on a planet. So becoming a global brand and scalability is no longer a question that you need to open offline stores in every country and then only you can become a global brand. Today, a global brand can be a success story by Instagram, or maybe a Facebook or a Twitter. So I think the cost of doing businesses will also come down, and hence you will see far more disruption across legacy businesses getting created not only in India but globally also. So I think that's a massive transformation which we are seeing across the businesses side.
Rajesh, I think business cycles we have seen with time are getting shorter, right? You are seeing sector rotation, which is becoming much more frequent now. How, as a fund manager, are you responding to these changing business cycles and sector rotation?
So I think you are absolutely right. The business cycles are getting shorter and the response time is reducing. And therefore, as a fund manager, I think our very important job is just not to identify the early winners, but also most important is to decide when to exit. And I think the discipline exit strategy is something very, very important. What we look at internally. So keep tracking the valuations, keep tracking the underlying growth assumptions, and keep tracking the into the business cycles. So, for example, whenever we believe, like specialty chemical, just to be an example, so we owned specialty chemical in 2018, and by March 2023, most of the stocks ballooned, and of course, China decided to reopen at that time. So we made specialty chemical zero, and the same stocks went down by 40-50%, and again we re-entered. Or similarly, for example, say IT. When Donald Trump got elected, everybody was positive on IT industry, make America great again, and so on and so forth. But by June 2025, the US policy started becoming anti-India. So we made IT zero. So what is very important is cycles are getting shorter, and therefore as a fund manager, we need to prudently, what I would say, in a very, very fast basis, we need to understand the implications and accordingly make the required changes at the portfolio levels. In last, I would say 2 years in particular, the tariff war, for example, was unheard of. And nobody thought that, what all of a sudden become the tariff play. Supply chain crises are still manageable because it is more of a postponement rather than, it doesn't destroy the permanent demand. It's more of a postponement. But tariff basically makes one country significantly different compared to other country. So one was tariff, and then US policy, many of such policies were against India, and then again AI war, and then the US-Iran oil. So in last 18 months, I would say somebody who would not have seen last 20 years, all those 20 years things probably happened in last 18, 20 months. And hence the agility is very, very critical. I need to keep, so we are very active managers. We keep changing, our sectoral allocation, depending upon how do we see the growth and how do you see the valuations. As I said, everybody knows what to buy. Tell me when to sell. And that's where I think the role of fund manager is all about.
Yeah, thanks. We'll take up a few audience questions as well. Pankaj, there's a question from Abraham. Does low free float in Indian markets distort price discovery?
Yes. To a certain extent, yes, obviously, because the promoter holding in India still continues to be high compared to other global standard because there's no single promoter globally. So to that extent, obviously, that's the case. But I think in many other companies, especially sectors like bank, now virtually there's no promoter, so there's entirely free float in large banks. In many other companies, new age businesses, there's virtually huge free float which is there because there's no a single promoter is not more than single digit or early double digit holding. So it depends from sector to sector. But yes, in certain mid and small caps, one needs to be careful. If the holding is too much concentrated in few institutions as well as including promoter, and there's very little free float available from an overall perspective.
Rajesh, there is a question from Hitesh on what should be the ideal market cap allocation for an HNI investor investing new money at this point of time.
Well, I think it depends upon the client profile, and I'm sure you can connect to client associate, wealth manager who will understand his risk appetite, because it is just not about the longer duration. But I've seen many investors, they all say I have a 5-year, 10-year horizon, and when the market goes down 20%, next day morning they'll call you and they say, hey, क्या लग रहा है, market तो इतना घुस गया अभी, अभी क्या करना है. So it is not like 1 month, 3 months, 6 months basis, but you cannot change your portfolio allocation. And while investor might feel that I have enough patience, that patience runs short when the market starts going down and the underperformance happens. So you need to give the manager longer time period. Of course, you can review on monthly basis, quarterly basis, not a problem. But ultimately, what is important is your patience. Your emotional health is more important than financial health. I think financially, India has many super HNIs. But what is important is that how do you control your emotions? So just ask one question to yourself. If the market is down 20% tomorrow, you invest 100 and market becomes 80, what will be your reaction? And mind you, you have a lot of peer pressure because the next door neighbor will say that, my portfolio is up and you are down, and that's how typically India works. So you need to really figure out, what is your risk reward matrix. If your risk reward matrix allows you 5+ years of time horizon, little bit more volatility, then surely mid and small, deserves a good allocation. But if it is what I would say in between somewhere, then I think the best option is multi-cap, because in multi-cap, like at least in our multi-cap, I think even for the market, it gives you all three combined, large, mid, small, so all seasons portfolio kind of thing. So it's an all-weather portfolio, like our multi-cap is all-weather portfolio. And of course, we keep changing depending upon how do we see the opportunity in the different buckets. So that's how the portfolio should be. But 5 years view, clearly mid and small will do better, but with a higher volatility. It will test some patience. Market at times are brutal, so you need to keep in mind those things before you decide that should I invest significantly into mid and small bucket or not. And last but not least, when you are investing into mid and small bucket, please keep checking, because from 150, 250th company to 5,000, everything is painted with same brush. So you need to make sure that in which bucket you are. Are you into large mid, mid small, small, or micro? Depending upon where you are investing, your risk reward, your drawdown, the alpha will be completely different. I hope that answers your question.
Yeah, thanks, Rajesh. Uh, Pankaj, there was a question from Samrid. How much is the China plus one opportunity translating into real manufacturing competitiveness for India? And what do you see as the key challenges?
So I think it's no longer a thought or a chat room discussion. Okay, it's finally percolating down to business decisions, and many places, companies we speak to across sectors are saying that uh, given an opportunity, most companies, large OEMs, are open-minded in terms of diversifying their supply chain base. So I gave you examples before that on the many companies which we spoke to, and they are saying that it's not only their decision, but there is a strategic call at the country level also, and there is a report we need to submit to different government agencies on how much your sales come from China and how much is your supply chain dependent upon China. So I think inherently, when you submit every week, every fortnight such data as a business head, you in your mind also starts to think about that. Uh, you need to diversify your supply chain a bit, and that's actually starting to percolate. Don't forget, these decisions, these execution takes much longer time than we all expect it to happen, because these are finally long-term strategic supply chain decisions, and you cannot happen in overnight and in one day. And let me give you small examples. Uh, so aerospace is one place where you will see massive supply chain realignment happening place, right? Just to put things in perspective, to make an aircraft, you need 4.5 lakh parts. Uh, and anyone, either Boeing or Airbus, have 16,000 vendors globally, either of them, right? India has about 250, 300 vendors altogether combined. And out of that 4 lakh parts, 4.5 lakh parts, India must be doing maximum 10 to 12,000 parts. Different, all these 250, 300 combined. So we happened to meet one of the large companies on the aerospace at the shop floor of our investing company. And their entire thought process was that we need more such companies in India, because our order book till 2040 is full. And there is a huge realignment of supply chain happening from Europe, because most of them either don't want to continue as a succession, or they have raw material or energy cost challenges. And we see that writing on the wall. And we want to develop many more such companies out of India who can cater to our supply chain requirement. Now, just think about it. These 10, 12,000 parts, if it moves to 40, 50, and then a lakh part, still 25% of the entire parts which goes into it. But for Indian ecosystem, that could be a very large opportunity which has started to stare in front of us. And I can go on and on and on in terms of ground feedback across sectors. Think about, from a global perspective, a pipe company which is recently, day before yesterday, received one single order of 17, 18,000 crore. When would have you expected an Indian pipe company getting 18,000 crore of order from US customer? It could have very well gone to other parts of the world, but it went there in that company. So I think there is a real opportunity. How much we can harness, how much we can execute is upon us, to be honest with you, and in a cost-effective manner. Still, will it be right on my part to say that we can replicate the manufacturing of China? Answer is no. We are not years, decades behind, right? China is moving to robotics, dark factory, ghost factories. You go and see, seeing is believing, right? So from that perspective, we are still behind, much behind. But in that diversification, can we get the part piece? which will be great from our growth perspective? Answer is yes. And you're looking at that in electronic industry also. Look at how a Dixon got created, how the entire EMS space got created, and this is just a start. You will see many, many more such opportunities emerging our way across hardware, softwares, in terms of entire ecosystem on data centers, and pick and shovel approach across the board. So I think opportunity is real. Which a company, which entrepreneur, which sector can take that opportunity, will time will only suggest. But very excited about this opportunity which is right in front of us across the manufacturing sphere.
Right. One last question before we move to the rapid fire. Rajesh, what are your thoughts on new caste system? A question from Rishabh. Is it making investors, especially the FIs, uh, hesitant and uncomfortable?
What the in the long term, I would say that's what the recommendation by the regulator along with the exchanges. Because if you look at the global exchanges, that's what they look for. So it will. So first thing, SRES system will absolutely survive. SEBI and market authorities have sent clear signal. There is a permanent fixture of India's market evolution. The regulatory backing is very strong, and I think it is a very strong, superior, I would say, anti-manipulation capabilities, because when you use cash, it is like the global best practices. Look at, I think, New York Stock Exchange, look at London Stock Exchange, look at Hong Kong. They use the closing auction to settle, end of day equity valuations. So our transfer to cash system is I would say it's a non-negotiable step. It will attract mature institutional global funds which rely on predictable closing prices. And therefore, I think it's a very important step. The transition always takes time. There are always some issues, technical glitches. It happens, but that doesn't mean that it is what I would say, it is a negative step. I think it is a huge positive step. We'll learn on the journey, and maybe it's a question of time. Maybe another 2, 3, 4 sessions, and I think the system will evolve, and it will further improve the overall FI interest in the country.
Perfect. So now we'll have a quick rapid fire. We'll just have 3, 4 quick questions, and would request a very short, crisp, one-word answer. Starting with you, Pankaj. Do you like IT as a contrarian bet now?
Very selectively.
Rajesh?
Very, very, very selective.
Rajesh, which book on one investing and one non-investing book, which would you recommend to investors or to audience?
I think The Psychology of Money is a good book, and a non-investment book, Agam, if you are following Jainism, Bhagavad Gita, or Ramayana. I think they all have the enough lessons for life for across segments, be it business or non-business.
Pankaj?
So in investing, I would strongly recommend everybody to read this book. So there's been a famous quote of Charlie Munger that all I want to know where I'm going to die, I will never go there. So that's very much converted into a book by Peter Bevlin, and that's a conversation between Warren Buffett and Charlie Munger. It's a must read. Every time you read, you probably take away a very different message. So very deep, insightful book. And from a non investing, I think Gita is one which I think everybody should read, especially chapter 2, 4, 5, 17, 18. I think these are the 5 chapters one should definitely read. I think a lot of connections between what we talk about. And third, life में ये सोच के चलो कि there's one difference between life and investing. Always remember that investing in the long term is very predictable. In the short term, कल क्या होगा मार्केट, परसों क्या होगा किसी को नहीं पता. Opposite holds for life. कल का शेड्यूल पता है अपने को, परसों का पता है, 5 साल आगे क्या होगा लाइफ में नहीं पता. सो अगर आप ये डिफरेंस को समझ जाओ, you will approach life and investing very differently. And I think Gita, a lot of connection you can find and a lot of interesting things you can find on a daily basis, both on life and business and investing. So I think both on investing and non-investing, I think these are the two books you should be very well versed with.
So, Rajesh, large cap, mid cap, small cap, or micro cap? You can choose more than one.
I think large and mid and small, not micro, clearly.
Pankaj?
I think in the current juncture, I would go for small. I think there are many opportunities which we are seeing available, and good businesses. It's unfortunately, as Rajesh mentioned at the start, that above 250, market cap, your everything is defined as small cap, which is not the case. In US, 500, $800 million is classified as small cap. यहाँ पर 32,000 करोड़ is small classified as small cap. So 32,000 करोड़ को पहुंचने तक लोगों की जान निकल जाती है, बट वो क्लासिफिकेशन में स्मॉल कैप है. सो आई थिंक देयर आर मेनी ऑप्शंस अवेलेबल, बिकॉज मिड कैप में हो क्या रहा है, 150 में रिस्ट्रिक्ट हो जा रहे हैं. सो डेफिनेशन है, बट दैट क्रिएट्स अ क्राउडिंग आउट बिकॉज सो मेनी फंड्स आर चेजिंग दो सेम 150 स्टॉक्स. But in small cap, the real opportunity is there. And if you can identify few of them which migrates from small to mid and mid to large, the value creation which you can get is fantastic. And we have seen some of them playing out in our portfolios. Lovely. You start with 7-8 thousand. You think that आपने मिस बस कर दिया, बट वो 7-8 हजार वाला 60-70 हजार कब होता है आपको पता भी नहीं चलता. बहुत फास्ट हो जाता है. So if they execute well, so I think that space looks to be very poised. The market caps between 7-8 thousand to 15-20 thousand crores. It's a very large market cap range, and you get some very good quality companies there. And 5,000 is the new club. So you have a large number of companies above 5,000 crore market cap. So 5 से 30,000 करोड़ की अगर आप मार्केट कैप को अगर आप ले लो तो बहुत अपॉर्चुनिटीज मिलती हैं आपको. सो दैट्स वन स्पेस आई थिंक कैन क्रिएट अ लॉट ऑफ वैल्यू इफ अप्रोच राइटली फ्रॉम अ बॉटम अप बेसिस. So small cap will be my first preference of choice.
Uh, last question, Rajesh, rupee at 100 or rupee at 95 1 year from now?
I think between 95 to 98, of course, predicting rupee is, I don't think I have any competence to predict rupee, because to predict rupee, you need to predict crude oil. And also you need to predict the US 10-year and US 30-year. And of course, you also need to predict whether Russia will do further war on Ukraine and what Iran will do to US. So I don't think it's anyone's cup of tea. But so from portfolio perspective, therefore, what we do is that buy businesses which are what I would say more inflation proof, because ultimately you must have the pricing power. So whether can crude oil goes to 110 or whether crude oil becomes 70 tomorrow morning, I have no clue. But if my company's a pricing power, then maybe with a 3-6 months lag, they will be able to demonstrate the pricing power. They will survive. They will remain vigilant. They would have under leveraged balance sheet, and that's the best way to grow. So I think never predict crude oil, never predict currency, because you will always go wrong when you predict it.
Pankaj, rupee to appreciate or depreciate?
Appreciate.
Great. Thanks a lot. This concludes our webinar today. Thanks a lot, Rajesh and Pankaj, for taking time out and answering all the questions very, very patiently. And thanks to all our audience for being a part of this webinar. We will see you soon with another discussion. Have a wonderful evening. Thank you.
Thank you,
Thanks,
Mayank.
Rajesh. Thanks, Pankaj.
Thank you,
Thank you,
Mayank.
Mayank, for this wonderful opportunity. Thank you.
Thank you.
Thank you.